Okay, we are live. I'm trying to make sure that you can see this. We should be live though, and I want to get started. I want to thank everybody for being here again. Hey, we're here every Sunday at 1 p.m. Eastern, 10 a.m. Pacific. Just a great chance to reach out to everyone there in the community and
make sure that you can see this.
Okay,
we should be live though.
I've got some. There we go. Okay, sorry about that. Some technical problems. Not as bad as last week though, where I accidentally had the live stream set on unlisted, so nobody could see it. So that kind of messed up last week's plans. But we're back, and like I said, we're doing this every weekend, Sunday, 1 p.m. Eastern. I thank you for all being here. It's just a great chance to reach out to the community, answer your questions, talk about kind of a topic of the week. I want to give a quick shout out and a special thank you to G.E. Stroud, one of the great members in our community. Always great at leaving comments and having that back and forth on the community. He actually pointed out that originally I had this live stream set for 12 a.m. So it would have been last night, 12 a.m. I pointed that out. I appreciate it. Thank you, GE. Again, always love talking back and forth to everybody there in the community. So I think we're ready to go. Just let me know there in the comments if you can see me, if everything seems to be working all right. I'm trying a new software this week where we're scheduling the live stream instead of just going live at 1 p.m. Eastern. So we're scheduling everything, and I want to make sure everything's synced up and you can hear me all right. So we got 3 a.m. in Australia. Yeah, sorry. I'm trying to kind of get the timing down right so everybody can join us and everybody can benefit from this. Just real quick, what we're going to be talking about today. It's going to be like a lot of the live streams that we do. We're going to start out with some community shout-outs. Had some great community questions in on the videos, comments on the videos over the last week. I wanted to address some of those and really say thank you to a lot of the people that are regular members of the community here and engage and interact with the videos and everyone in the community. See some of you in the live stream today. Greg, good seeing you. Dante, Lynn, Mike, hey guys, great seeing you, everybody here. Lacey, thank you for that. It says everything is fine, so we are set to get ready. So after we doing those community shoutouts, I'm going to highlight a few of the videos last week and the videos coming up. We got a really important video coming up tomorrow. Actually, Monday is going to be our May update to the 2019 Dividend Challenge portfolio. So I'm going into M1 Finance into our portfolio and showing you what's changed there. I've actually sold some stocks, and we're going to talk about that today, and then tomorrow's video is going to go into a little bit more depth into what I'm looking at, why I'm selling some stocks, and really what you can do as a long-term investor. I know a lot of you have longer-term focuses. A lot of the reason why I'm selling stocks in that 2019 portfolio is that it's a kind of a 1-year time frame, right? I'm trying to see what I can get out of a 1-year portfolio. So I have to be a little bit more in tune to month by month changes and even this 1-year change in the market. But you don't necessarily have to do that as a long-term investor. So today and then in tomorrow's video on that portfolio update, we're going to talk about that long-term investing versus the short-term investing, how long-term investors can rebalance, reposition their portfolio according to some short-term signals and maybe really do a little bit better. And then of course we're going to have the Q&A there. People still coming in. Mike, Zahan, thank you for being here. Is the echo still bad? I thought it was the dual lives, but so we'll see if we can get that fixed here. So just highlight a few of our comments that we came in. So I'm gonna transition over here. Our first comment was from Dispatch Express. It was on one of the affiliate videos last week. Had some great videos last week on affiliate marketing. We'll talk a little bit more about those as well. But this comment, it's talking about the hardest part of getting that affiliate funnel system is getting traffic to your funnel. Whether you start your funnel off at a blog site or YouTube or whatever. And I feel you. Distribution is half of the game. Anytime you're talking about earning money online, okay, there's always distribution and there's product. You can have a blog, a YouTube channel, a huge social media following on Instagram or Facebook or whatever. That's the distribution. That's how you reach people. Or you can have the product where you have something to sell. You have your course, you have your affiliate marketing, you have other things, and so you don't necessarily need that distribution if you have these products and you sell it through maybe some of these other things. But of course, the best thing is to always have both of those. So what I always recommend is to try to develop both of those. Have your own blog, have your own YouTube channel to have that distribution and develop those own products so you can sell them together. Now, if you don't have your own blog, if you don't have your own YouTube channel, there are some ways that you can make this affiliate marketing or your own products work. But it is going to mean reaching out to that distribution, to the people that have that distribution. So one good idea is kind of a guest blogging idea, right? So what that is, you just reach out to other bloggers that have their blogs or even YouTube channels or whatever, and you offer to provide content to them. So you write up an article or you make a video for their channel, and then within that, then you offer this lead magnet that we talked about in that affiliate marketing system. You offer this this free handout or this free checklist, something like that, to their readers or to their viewers. And that's your distribution. That's how you get people onto your system. Now, of course, if you don't have your own blog or your own YouTube channel, what do you have to offer these people for a guest blog or to use their social media channels to distribute your advice and your lead magnet? So sometimes you have to pay. That comes into advertising, stuff like that. You need something to offer them in return. If you don't have, maybe if you only have your large social media following, then you can offer them to share their blog through your social media followers and your community there. But that's why I really always suggest starting a blog, starting a YouTube channel as that point of distribution, because you really do need that distribution side of the making money online, and it's so easy. You can start a blog in less than 5 minutes with Bluehost or some other web host, and it's not overnight, but it'll build gradually. I get well over 100,000 visitors to my blogs each month, and it's been about 4 years, but that's consistent. 400,000 plus for each month, and that's all the distribution I really need. I get another about 350,000 views on my YouTube channel each month. So about 500,000 visitors to YouTube and my blogs each month. That's all the distribution I need for all these products, the affiliate channel marketing, all of that. Okay, so it is a kind of a two-sided coin that you need to work on. The second comment here that we'll look at is from Sean. He was just asking, if anybody has any suggestions on making money or making time for writing when you have a full-time job. And this is really, this is one of the three questions that I always get about side hustles and about making that money online and getting started. The first is, finding the right hustle, finding the right idea that works for you. The next is that making most of that limited time, because I like a lot of you, I didn't start just full-time online. I was still working as an economist for the state of Iowa while I started my blogs and while I started a lot of this. And it's tough, it can be tough making that time to work, even if it's just 5 hours a week on your blogs to get another post up or to reach out on social media, that kind of thing. But the beauty of a lot of these things, this YouTube channel, a blog, start becoming a social media influencer or something like that, is they can be done on as little as 5 hours a week. So really, it has to start with a passion, and that starts with finding that right side hustle for you, that right idea that comes from your hobbies, comes from what you enjoy doing, what you enjoy learning about anyway. So basically, if you spend 5 hours a week learning about personal finance anyway, well then you can use that 5 hours a week to grow your online business, to grow your personal finance blog or something like that. And that's just going to make it easier to, not necessarily feel like you're working those extra 5 hours, but you're just creating that hobby that is eventually going to make you money. So yeah, 5 to 10 hours a week at the most to start off with while you're working that full-time job. But you do need to make some of those disciplined decisions, like watching less TV. And that's a hard one for me. I love my Simpsons. They're actually, one of the local cable stations here is actually doing a 30 days, the entire library of Simpsons episodes. So each day they do a whole season, something like 12 episodes each day. So it's hard not to watch, at least an hour or two of those episodes. But you need to be disciplined, and you need to cut back that and find time where you can. That doesn't mean taking time from your family and taking time from the important things, but everybody's got an hour a day or so that they kind of waste, and they're not really using as well as they could. So yeah, it's just it's about making those disciplined decisions, finding the right side hustle that is more of a hobby and more enjoyable to you, so you don't feel like you're working, and that kind of thing. So our third comment here is from Golden Boy, another great member of the community, always commenting on the videos. I appreciate it there. I appreciate your input, your feedback, and the questions. Because it's through these questions that I get ideas of what you want to see on YouTube. It's directly from these questions and these comments on the videos that I'm like, okay, well, I'm getting this question so many times that I better make a video on it, because that's what people want to know. So Golden Boy's question is, which retirement fund do I have, a Roth or a traditional IRA account, and which is best? And I'd say both. You've got to have both. So if you don't know, there's two types of your own personal retirement accounts, right? This isn't talking about your 401k at work. This is a personal self-managed retirement account, and it's either a traditional IRA where anything you put into it, then each year you can take that off of your taxes, off your income taxes. And these are for U.S. investors, and I believe Canada has a similar program, and a lot of countries have similar programs to this. But you can contribute up to, I think this year it went up to $6,000 into your IRA account, and you can take that off of your income so you don't pay income taxes on it. Well, when you take that money out in retirement, and you can't take it out until you're like 59 and a half, but we all need money for retirement, right? A lot of people, they tell me, well, I don't want my money locked up until I'm 60 years old. What, are you not going to need that money when you're 60? We're not talking about putting all of your money into these retirement accounts, but we're talking about, maxing out your deductions, $6,000 or as much as you can to have some money left over in retirement, because we're all going to need that money. So you put that money away, and when you, in a traditional IRA, when you take it out after you turn 59 and a half in each year, then yeah, you have to pay income taxes on that. So you pay taxes on what you contributed because you didn't pay them before when you put them in, and you pay taxes on the returns. Now compare that with a Roth IRA, which is just a different type of retirement account. When you put money into a Roth IRA, then you don't get to take that money off of your income. You're still paying taxes. So this is regular money that you've got. You're putting it in a Roth IRA account. What's magical about this one, though, and truly, I mean, you need them both, but I love the Roth IRA, because when you take that money out in retirement, you pay nothing on it. It's tax-free. So what that means is, yeah, you pay taxes when you contributed that money. When you earned that money, you pay income taxes, and you put it in that Roth IRA account. But when you take it out, there's no taxes. What does that mean? That means you never paid taxes on those returns. This is the single best investing idea to get tax-free returns. So you definitely need a Roth and an IRA. A lot of this, the decision which one to invest in, because you can only invest that limit, that $6,000, you can only invest total in one or both of those each year, right? I can do $3,000 in each, or I can do $6,000 in one, or whatever, but I can't do more than $6,000 in either of these accounts. So what used to be the decision is, okay, well, what's your tax rate now? What's your tax rate going to be in retirement? Which is better? Do you need that tax deduction now? But really, it's all about being able to balance that tax-free income and that income in retirement, right? When you have both, you're going to be able to say, okay, my income's a little bit higher this year. My taxes are going to be a little bit higher, so I'm going to take a little bit more money out of that Roth account and not pay taxes on that. or maybe I don't have as much income this year in 1 year in retirement, so I want to take a little bit out of the IRA account because my tax rate is lower. So it just gives you that flexibility when you have both of those accounts. So definitely you need both of those accounts. Now, my strategy for maxing out these, because like I said, you can only put in $6,000 currently is the $6,000 limit each year into both of these. Okay, so if you split them up, you only get $3,000 in a Roth and $3,000 in an IRA, and you only get that $3,000 contribution credit from the IRA, the tax write-off. What you can do though, and this is something that the top 1% of the people with those financial advisors, they're doing this, and this is what I used to recommend to them, is that you max out your IRA contribution every year. So you put that $6,000 all into a traditional IRA every year. Then every few years, and this takes a little bit of planning because you're going to have a higher income tax payment, but every few years you can take some of that money out of that traditional IRA and convert it into a Roth IRA. And that doesn't go against your limits, right? So if I'm putting $6,000 into my IRA every year, I go 5 years, I've got $30,000 into it, plus the returns, whatever. So I go 5 years. In that fifth year, if I want to, I can take $20,000, put it into that Roth IRA. Okay, so now and then that same year I can still put $6,000 into that traditional IRA. Whatever those conversions from an IRA into a Roth, they don't count against the limits. So now what am I doing? I've maxed out that $6,000 annual contribution, but I've still got, I still control how much I want in my Roth. So now I've got that $20,000 in the Roth, and then so it'd be like $16,000 in the IRA. Now the caveat there, and how you need to work this, is when you do convert that money from a traditional Roth that you didn't pay taxes on when you made it into a Roth, then you're going to have to pay income taxes on that amount. So it takes a little bit of tax planning if you can, or just a little bit higher tax bill. But it's a great way to, like I said, to have that flexibility in retirement. So again, great questions this week. I appreciate it. Again, anytime you see a video, if you've got a question, a comment, use that comment section, because I love reading through it. I answer every single comment, and it's really my chance to interact with everybody in the community and all of that. So now we're going to talk about real quick last week's videos. This next week's video is coming up, and then we're going to get into that. Should you be selling stocks now? The market outlook, and I've got a really great research tool for you that you can use to really see some of these ideas. So like I said, last week we did those 2 affiliate marketing videos. Love affiliate marketing. It's probably about a third of my income. So upwards of $4,000 or $5,000 a month. And what's so great about it is that once you do build up those distribution channels, so a blog or a YouTube channel or a social media following, then that's your distribution. That's all you need, really. That's half your business right there. And these affiliate marketing, that funnel system that I talked about in those 2 videos this week, really show you how to make that passive, how to set that up. So if you didn't see those 2 videos, go back and watch those 2 videos if you're interested in making money online, because it is one of the key ways that people are making money online. I've got a few blogging videos coming up that show a blogger survey that I did with 150 bloggers, and 70% of them are using affiliate marketing. That's how popular it is. That's how well it works. So definitely go back, check out those videos when you have time. Friday's video was a real estate interview with actually a friend of mine with Streetwise. They run a real estate investing fund, and we just kind of talked about where the market is going, where the real estate market is going, and some questions that I've had from you in the community about real estate. Next week's video, like I said, really excited about the portfolio update coming tomorrow. Our 2019 stock market challenge portfolio update. So I'm cool. So I'm updating the portfolio tomorrow. We actually had right around 24% returns so far against S&P 500 is right around 14%, I think, on the year. So still beating the market, still almost about 10% over the market return. So really happy about that. Actually got 2. I sold out of some of the stocks, and we'll talk about that pretty soon here, and actually bought into a couple of funds there, and we're going to talk about how to do that and what to look for in different different funds and the market outlook. So definitely check that out tomorrow, and that's coming out 10 a.m. 10 a.m. Central Time is when I publish on Mondays, Wednesdays, and Fridays. So check that out. Now the topic for today, and I see a few people still in. And again, if I don't get to your question, please ask it again at the end during the Q&A, because I want to hear and answer all of your questions there. But where's the market going? Should I be selling stocks? That kind of thing. It's a question I get all the time on the channel. And for the most part, for longer term investors, you really don't have to worry about it too much if you've got a time horizon. So if you're not, it's going to be more than 15 years till when you're using that money, till retirement, till your those college expenses, things like that. Then you really don't have to worry about it too much, because you're going to be investing throughout many recessions, many stock market crashes even, and it's all going to tend to even out. But that doesn't mean you can't rebalance, reposition when the market starts looking a little weak, and maybe get out ahead of the market and protect the money you've made. Okay, I hear a lot of people, they don't want to try to time the market, they don't want to try to buy and sell stocks, and that's fine. But there's nothing wrong with protecting the money you made, and really that's what I'm looking at when I say sell stocks. Okay, I'm talking about looking for that protection, looking for some of the ideas that are out there as far as market outlook and that kind of thing. So we're going to start off with talking about just kind of the economic outlook, but then I'm going to talk about just looking at those earnings, and that's really where we need to be looking at for this shorter term 1 year time horizon, right? We're not talking month to month. Nobody can time the market from month to month. But you can look at some of these signals, some of these earnings signals, this economic outlook, and you can see kind of where the market is going over the next year. Okay, so the global economy isn't bad, right? U.S. economy isn't bad. It's actually kind of a Goldilocks scenario, some would call it. But there's no argument that it is slowing down. Okay, the OECD or the World Bank has just released some of their projections for for this year and for the next, and it is a slowing rate of growth. Okay, the U.S. Was expected to do right around 3% for last year, for 2018, and is now expected to do right around maybe 2.6, 2.7% growth, economic growth for 2019, and even slower for 2020. And that pretty much goes for all the developed markets. China is slowing down. Europe is slowing down. You get a lot of these trade disputes that may or may not be resolved, that even if they are resolved, it's still creating some kind of a friction that is uncertainty, and businesses hate that uncertainty. It makes it extremely hard to plan 3 months, 6 months, even years in advance. A lot of these manufacturers that are buying steel and have inputs from foreign inputs, they have production cycles that go 3 to 5 years, or if they're trying to figure out to build a factory, that goes 5-20 years. So it's very hard to plan for this kind of thing when you have so much uncertainty around trade policies and other things. That's not to say that we don't need a change in some of our trade policies and stuff like that. I'm just saying it just makes it very hard to plan, and that kind of that weighs on the economy. And we're starting to see that with a lot of these numbers coming through. We just had a manufacturing index called the ISM manufacturing came out last week that showed the slowest growth in the United States since 2016 from that manufacturing sector, and it's not a huge sector of the U.S. economy anymore, but it is very important. But the services sector, which is a much larger part of the U.S. economy, also showed the slowest growth since 2017. So it is undeniable that the economic growth is slowing down. Profit margins at companies has fallen. In the first quarter, we're getting all our first quarter earnings data, and profit margins have actually fallen for the first time in years. They're right around 10.9% average profit margin on the S&P 500 companies. So that's the first time in a few years that's fallen. And what I want to do is I want to share with you probably one of the best resources that you can find for getting really that pulse of the stock market and the pulse of earnings and things like that. So we're going to go to Google, and you're going to type in FactSet research. Fact, so FACTSET research. And we're going to go earnings insight. That's right. FactSet earnings insight is what you should be typing in. Sorry about that. FactSet earnings insight. And it will almost always be the very first one, right? You'll see a PDF there, which is a document, a downloadable document. And FactSet is just it's a research firm that researches earnings. So, and they update this document about every 2 weeks, every week. I think it's on Friday they update it. And they put it out free there to download. And they track all the earnings, the profits, everything in the the S&P 500 companies. So you're gonna click through there, and that'll download the document. And I mean, this is an excellent resource for anybody that wants to follow the market, wants to follow earnings. Like I said, they track all the earnings for the S&P 500, right? So every week, every 2 weeks when they update it, you'll see this earnings scorecard, and it's mostly for use when earnings are coming out. So right about now, we've got first quarter earnings coming out. They always report, what percentage of companies have reported. So here we see for the first quarter of 2019, 46% of the companies in the S&P 500 have reported so far, and this is as of April 26th. It'll tell us, how many companies, what percentage of companies have reported positive EPS surprises, how many have reported negative EPS surprises. It'll show us, the average earnings so far reported for that broad index. It'll compare that with, the last year. It'll compare that with the last quarter. It tells us, by sector. So of the 11 sectors, you've got consumer discretionary, consumer staples, energy, utilities, all those sectors. It breaks it down and really shows you the pulse of where earnings are going. And why is this important? Earnings are the ultimate test of where the stock market is going, right? Your stock ownership is an ownership of those future earnings. So you really want to know where earnings are going. Obviously earnings are very important for dividends, right? Because you can't pay out if you don't have growing earnings. You're probably not going to be growing your dividends or even paying it out. And it's also very important in that price to earnings ratio. These are three factors that we're going to talk about in tomorrow's a portfolio update, but I just want to touch on them here a little bit. If you want to know where the stock market is going, you only need to know those three things. What's the earnings growth? So how fast are companies going to be growing that part of your ownership, that stock ownership in those earnings? What's the dividend yield? Okay, because you've got your price growth, which is on those earnings, and you've got your dividend yield, your dividend return. And what's the PE ratio? Right now, investors are paying about 18.5 times those trailing earnings. So investors are willing to pay 18.5 times the earnings made by companies over the last year as prices, right? So that's going to fluctuate up and down, and especially when you're looking at these short-term market signals. Okay, when you're looking at what's the market going to do in a year, then it's all about that investor sentiment, that price to earnings ratio. Okay, over the very long term, it's all about earnings. Okay, it's all about that growth in the company. But over the short term, it's all about that investor sentiment with that price to earnings ratio. So we're going to go back to this FactSet Insight research, right? Okay, and again, earnings insight. It's by FactSet. It's put out updated every week or two, especially during earnings season. And what we see here, besides just an amazing amount of detail, is okay. So here's net profit margins, like I was talking about. So net profit margins. First time it's declined. It declined in Q3 of 2018. Of last year, but 10.9%. So it's the lowest it's been since Q4 of 2017. And where is this lack of, or this loss of profitability come from? And you can read a lot of that in here. But basically, what we're seeing is, we've got full employment. We've got the lowest unemployment rate since like 1969. Okay, so in the U.S. and a lot of the developed countries are seeing the same thing. So employers are having to raise those wages to keep good workers, to bring on new workers, but they don't quite have that pricing power. Okay, they're not able to raise those prices because general inflation isn't going very fast either. So basically, they've got higher wage costs, they've got higher commodity costs, A lot of the commodity inputs, especially for the consumer discretionary or consumer staples side, have been increasing quite a bit, and they're having to eat these costs. So what is that doing to their profitability? It's going down. So this is probably one of the biggest one of the biggest things in the market right now that very few people are talking about is this loss of margin, this loss of profitability. Okay, and obviously, anytime you're less profitable, your earnings are going to go down. Okay, and really how you tie this together is, you've got your earnings growth, which we'll talk about pretty soon here, what the earnings growth is for the S&P 500 this year, and and then the price to earnings ratio. So how much investors are willing to pay for that earnings growth. Well, the problem is that at 18.5 times price to earnings ratio, investors are, they're hot right now. They're ecstatic about earnings. Well, what happens is when that earnings growth does start to go away, those profit margins come down, then not only do you have lower earnings growth, which affects, the actual value of a stock, but you've got that shrinking investor sentiment too. Investors don't quite know when that profit margin is going to stop shrinking. They don't quite know, how bad that earnings growth is going to get. So maybe they're not paying 18.5 times trailing earnings anymore. Maybe I might pull it back to 16.5 as a market as a whole. So now not only do you have lower earnings growth, but you've got that shrinking price to earnings ratio. And it really snowballs into some big stock losses. So we saw that profit margin, and you can look on here. They break down that profit margin, the changes by sector. So really important information there. Now let's look at the earnings. Okay, we've got earnings for the first quarter are negative 2.3%. Okay, so that means companies in the S&P 500 are making 2.3% less than they did the same quarter last year. Okay, so declining earnings growth, and that's something that we haven't seen in quite a while. Looking forward, and this is really where you start to get worried, and you start to build this picture of where the stock market is going. This is all just breaking down the current quarter for by sector. Here you can look at, looking ahead, forward estimates and valuations. Now you see, where do analysts, and this is where this FactSet Earnings Insight, they get all their information from, what companies are reporting and what analysts are expecting. They survey a lot of analysts out there, and they survey all the analysts out there to see, what they're expecting from a top-down, so from an economic perspective, as well as from a bottom-up perspective. And So for the first quarter, like we talked about, it's negative earnings growth from last year. Their companies are actually, losing money compared to what they made last year. For the second quarter, it's expected the same. Look at this. Second quarter here is expected, and I don't know if you can see this on there, but a decline in earnings of 0.6%, even as revenue growth is supposed to be about 4% next quarter. If that happens, and it won't, I'll explain why it won't, but if that happens, it would be an earnings recession. And anytime you start talking about the R word with stocks, it's not a good time. Now of course, there's a game that analysts and companies play as far as these earnings expectations, right? Companies always try to lowball the expectations for their earnings so that when they actually report earnings, they can report higher numbers, right? They can surprise to the upside. So look how great we did. Look how hard we worked. We beat the expectations. And it's all a game because after a lot of times during the conference call for earnings, they'll try to bring down expectations for the coming quarter. They'll say, this is going wrong, or we had some unexpected problems here, and that might affect the next quarter. And it's all just to play that game to lower the expectations. So when they do get to that next quarter, then they can beat their earnings. But with an expectation of negative 0.6% earnings growth for the next quarter, even if they beat it by 1% or 2% on average for the S&P 500, that's still going to be 1-2% earnings growth for the quarter on a year-over-year basis. Now, how great is that? You can even see, and you can see here. So analysts are expecting for Q3 1.3% growth, For Q4, 8.1% growth. And a lot of times you can look at these numbers and just, say, okay, this isn't going to happen. A lot of that 8% growth they're expecting for the fourth quarter of 2019 is going to get downgraded. They're going to start talking to management. They're going to start talking to people at these companies, and they're going to start manipulating those expectations. So that 8% growth isn't going to happen for the fourth quarter. So what we do see, and you can see here that for the full year 2019, analysts are expecting about 3.6% earnings growth for companies in the S&P 500 for the stock market, which would be extremely low. I think we had, and somebody correct me if you have the information right offhand, but I think we had double digits earnings growth for the last couple of years, something like 17% I think for last year and the year before. And a lot of this was that extra juice. We were just coming off monetary stimulus from the Fed, super low interest rates. The rising rates hadn't quite yet affected the economy, but then that huge tax package, right? The tax reform that lowered corporate taxes by like 20%. That was like a sugar rush, right? We are coming down off of this sugar rush, and you can see it in these numbers. Okay, expected 3.6% earnings growth this year, and that's and that's not real. That's nominal. Okay, so that's with inflation. Now, when you consider inflation is expected around about 2.2% this year, that means about 1.4% earnings growth. So if we go back and look at what stocks are actually the value of those earnings and dividends, okay, if you've only got 1.4% earnings growth, then what's that mean for stocks? Okay, they're only worth 1.4%. Intrinsically, they're only worth 1.4% more than they were the prior year. Plus that dividend yield, which is about 1.85% for the S&P 500. So put them together, and 3.25% growth, intrinsic growth for the stock market for this year. That is not particularly optimistic or a good picture. And then you start looking at, okay, those very high investor sentiment numbers, that 18.5 times price to earnings. When investors start to really see how fast this earnings growth is declining, are they going to be so optimistic? Are they going to wonder, okay, 3.6% next year, what if it's 2% the next year in 2020, or even negative next year, something like that? I might not be so optimistic about stocks, and I might bring that down to 16.5 price to earnings. That's when you start having a problem. So definitely use this. Look for this FactSet earnings insight. Like I said, they update it every couple of weeks, and it's just an excellent source of information. You see some of these graphs here, and another one I want to point out. They break all the earnings and everything out into the sectors. You can see which sectors and which companies have the biggest surprises. So Twitter had a 141% earnings surprise on their call, and you can start to look in some of these and see if there's kind of a trend that you can see. But I also want to go down here to, okay, you can look at the earnings growth by quarter for each of the industries, and I'm trying to find there's a chart that they always do that's a price to earnings ratio by. It's by sector, and they give a 5 and a 10-year comparison, which is really, really valuable, really something interesting to look at, and can really tell you where, what things are doing. They have the geographic exposure in all the industries, which is great to see if maybe you've got that dollar trend. Okay, so if the dollar is increasing in value quickly, then companies with a lot of foreign exposure, foreign sales, they're going to be hurt by that, and we see that a lot in those consumer staples companies that are reporting. Okay, here we are. So now they report forward 12-month PE ratios. Okay, so now that is where we usually talk about price to earnings ratios in a trailing idea. Okay, the current price versus trailing earnings. So the earnings that a company or a sector or even the whole market made over that last year. That's the price to earnings ratio. Now, when you're talking about a forward price to earnings ratio, you're talking about the current price divided by the expected earnings. So what do we expect this company, this sector, or this entire market to make on earnings over the next 12 months? Okay. and they're usually pretty close depending on what the expectations for earnings are. But you can see here that you can see the current forward price to earnings in this dark blue line. So for example, consumer discretionary products, right? Trading at 21.7 times forward earnings. Okay, investors are paying 21.7 times what they expect those companies to make over the next 12 months, which is really high. Okay, that's I mean, when you come to think of a good price to earnings ratio, right around 15 times or so, and that's trailing, then 21.7 times what they think earnings are going to be. Not even what earnings are right now. And you can compare that against this 5-year average, which is 18.8, and this 10-year average, which is 17.1. Now, with these average, understands that even this 10-year period, this is all within that bull market. Okay, this is all within that time frame where investors are happy, they're excited, they're enthusiastic, and investor sentiment is high. So you would expect this even these 5-year and 10-year averages to be higher than normal. If we took this out to a 20-year average, that wouldn't be 17.1. It would be more likely like around a 15 or maybe even a 13 or 14 handle. So if you look at this, you've got a current forward price to earnings ratio on consumer discretionary on the sector of 21.7, 10-year average of 17.1. So let's just do the quick math here, divided by 17.1. It's saying, okay, right now the consumer discretionary sector is 27%, pricing 27% premium on that 10-year average. Okay, so you can, it's a great resource, great tool. You can really go through some of these sectors and say, okay, which ones are maybe a little bit better value. We've got, so we've got utilities trading at 18.4 times forward PE. The 10-year average is 15, so still pretty expensive there. That's about a 20% premium. Energy. Okay, look at energy. This is one that's might be a little bit more value. You look at this chart and you say, okay, what is in energy? Where's the value and where's the opportunity there? And maybe start looking at some of these individual companies or even just the whole sector. Maybe you can buy the XLE, which is the select sector spider, the energy sector, because it's trading at a forward valuation of 17.3 times expected earnings, right? Whereas the 5-year average, the 10-year average is at 20.3. So it's actually trading at a discount to where that longer term average was. Now, of course, now you've got to say, okay, well, why is that? You got to look into what the earnings are expected to be in energy, and actually they're expected to be down. And look at that 5-year average and the 10-year average and see, what happened. Why were those a little bit higher? So you can't just look at and say, okay, well, energy is trading at a discount. I'm going to buy energy. I'm going to buy that XLE, or I'm going to buy specific companies. You can look, okay, here as the S&P 500 as a whole. So the broader index trading at 16.8 times expected earnings, okay, and remember those earnings are supposed to be about 3.6% growth, right, over the next year, about 3.6% earnings growth for S&P 500 companies, and it's trading at 14. It was 14.7 on that 10-year average. So that's a significant increase. Now what I want to do, okay, so we've got that earnings side, right? We've looked at the economic outlook. We've looked at these earnings. And again, tomorrow with our portfolio update for our 2019 stock market challenge, I'm going to be updating the portfolio, and I'm going to be looking at that model of looking at earnings, dividends, and the price to earnings ratio to really show you, where we kind of run into a dead end on the stock market this year. But then, this last point I want to make before I start talking about kind of ways to protect the money that you've made without having to necessarily sell all your stocks or time the market. We're going to be talking about rebalancing, repositioning to protect some of your money, as well as some of the tools that I use to protect my stocks and my investments. But most of you on the channel know, anyone in the community knows, I don't like these timing or these short-term trading signals, okay? I don't follow them that much, really. I don't believe too much in trading signals like maybe the January effect or, a lot of these trading signals, the Santa Claus rallies, things like that. They don't necessarily work all the time, and really that's what I'm looking for, right? So I don't follow these, but we just entered one of the strongest trading signals out there, okay? The sell in May phenomenon. And it's so simple that you think, how can this possibly work? how can it possibly be that selling in May and staying in kind of a bond heavy portfolio through October and then getting back in November, how could that be a good trading strategy? Because everybody knows about it. It's so simple, but it is amazing how effective this strategy has been. So basically the idea is you're investing in stocks from November through April, right? Starting in May, you don't necessarily have to sell all your stocks, but you pull back a little bit on stocks and you go to a bond heavy portfolio until October, right? And you just do that every year. Now, what we see, if you actually look at the numbers, and this is amazing, if you actually look at those numbers, somebody from 1950 to 2018, right? So 68 years, if they took $10,000, invested and used that sell in May strategy, if they invested in stocks from May to October, right? We're not talking about November through April here. If they had $10,000, they invested only May through October, rolled it over. Each year they went to cash in November and then they came back in May, bought stocks again. They would have lost half their money in that 68 years. And that's because some of those years. Yeah, the last, actually, I'll tell you, the last 5 or 6 years, the stock market has been up a little bit from May to October. But over those 68 years, they would have lost half their money because a lot of those years, you had those huge sell-offs, those stock market crashes and a lot of problems, or just a weak or flat market from May to October. So they would have actually lost about $5,800 that they would have lost. Out of that $10,000 over 68 years, just investing those 6 months, they would have had about $4,200 left of that portfolio. Now, the opposite side of that, the other side of the coin, if somebody would have taken that $10,000, invested only from May to April, okay, those other 6 months they just held cash, right? May to April, or not November to April, invest that $10,000 every year, keep rolling it over every year, it would add $2.8 million, over that same 68-year period. I mean, that's just the kind of data that you see that is undeniable, that there is something here that works in that phenomenon. And that's that's really there are some intuitive reasons for that. Those summer months are very slow trading months. A lot of investors, a lot of brokers and traders want to be at the beach. They want to be on the golf course. So volume just falls to nothing. Okay, during those summer months, and that a lot of times that exacerbates, that amplifies those swings in the prices. Okay, especially to the downside. People get very scared if it's a very low volume and those big trading swings. So that happens. You've got mutual fund and hedge fund activity into October, that a lot of selling, a lot of window dressings, things like that. So that tends to depress the market returns and the stock prices in that May through October period. Of course, when you come back, November, December, people, hedge funds, a lot of these same institutional investors are trying to make their portfolios look better for that year-end reporting. So they're back into the market. You've obviously got to that fourth quarter consumer spending around Christmas. That's obviously a very positive time. January, everybody's excited, everybody's optimistic about a new year, a new opportunity. So they're in the market. So it's just some intuitive reasons why this sell in May phenomenon actually works. So those are really the things that I'm looking at and why I'm selling some of the stocks in that portfolio that we'll talk about in tomorrow's video. So now, what do you do though? What do you do if you've got a longer term focus? You don't necessarily want to be selling your stocks a lot, and maybe it's a little bit of a misnomer. You're not actually talking about selling in May, because you're not selling everything. You're just repositioning. Okay, so I want to call it a repositioning or rebalance in May strategy. Okay, this is a perfect opportunity to go back into your portfolio and say, okay, is this really the portfolio that's best for me, right? Do I have, after 10 years of stock market runs, do I have 85, 90% in stocks, and where should it be? Even for younger investors, you need some bonds, you need some REITs, some real estate exposure through those real estate investment trusts. You need those other asset classes. So it's really a perfect opportunity to go back, kind of take some of that money out of stocks and put them into these other asset classes. There's also some things that, and this is the last part I want to talk about before we get to that question and answer. I see a lot of great questions coming through, and I want to get to those. But there's also a way to protect some of that money that you've made without necessarily having to sell stocks or without having to close up your positions and stuff. And I want to show you how to do some of that on here. Some of this might be is going to be pretty new for a lot of people. Okay, so the first thing we're going to be doing is talking about options. Okay, so options are just a a way to buy or sell protection. A lot of times you can use them for speculating, but really the best use is using them to protect the money that you've made in times like this, right? So there's two types of options, and you can get an option on any stock. So what we're going to do, we're going to go into Yahoo Finance, but you can use this on any stock trading platform, any investing platform. You can buy options. So we're going to look at Apple, AAPL ticker, okay? And what you'll do on your stock trading platform or wherever, then there's usually going to be an options. So you go to options. We see Apple is trading for $211.75 right now. Well, what we want to do here is we're going to look at two option strategies that are going to help protect your money. Okay, and both of them work, but there's just some difference there. Okay, the first one is we're going to talk about buying put options on the stocks or on the index. What a put option is just it's something that gives you the right to sell a stock or an index at a certain amount in the future, right? So we got Apple options here, and we're going to do this drop down, and we're going to say, Apple options for, I usually use the January options, but if you're looking at this sell in May mentality, this market weakness, maybe we'll only use the October options, right? And what you'll see is the further you go out, the more expensive these options are to buy. But so we'll use these October options. We'll go down here to put options, okay? And the strike price, this is the price where you're going to buy or sell the stock, okay, the actual stock. Now, put options, remember, put options are a contract or a right that you have to sell that stock. So what we're saying is with Apple at 211 here, then we can come down here to 210, right? So that's going to give us the option to sell Apple at $210 a share. Now, what happens here is if we own Apple shares, but we're kind of worried about, okay, maybe the September product launch isn't going to go very well. Maybe they don't have a whole lot of things to offer on the in that typical every year Apple releases products in September. Maybe they don't have much this year. We think they don't have much. So we're going to kind of worried about what that stock price is going to do. Well, we can buy these options and have the right to sell Apple at 210. So what this means is that if Apple goes down, if it goes below 210, then we can still sell it for 210. We can still sell our shares for $210. And you see that this is a bid and ask price right here. You see that people are you do have to pay for that option, right? You have to pay for that right to sell. So you have to pay $11.35. Basically what you're saying is that so if you're going to sell for 210, but you had to pay 211 for that, then you're expecting, or you want protection if Apple goes down below minus 1135. Basically, if Apple goes down below 198, right, which would be about a 6% swing. So basically, you are complete if you buy this option for you buy this option for 1135 to protect yourself at 210. You are completely protected if Apple goes down more than 6%, right, by that October expiration, right? And I know that a lot of this can be a little bit confusing, but it's something that is really a powerful tool to protect your stocks, to protect the money that you've made. Now, conversely, you can also do this on just the index. Okay, so say I still like my Apple stocks. I still think it's going to go up. I'm still a buyer, but I'm kind of worried about the overall stock market, right? And I'm kind of worried about what the if the S&P 500 falls. I don't care what Apple is doing. It's going to be hard for Apple to keep up those gains, right? So if I want to take the stock market out of my Apple investments, then basically I can buy put options on that index. So I do the same thing. I go to this SPY, which is the ETF index for the index, and I can go here to maybe October or even January. I can buy protection all the way through January 2020. I go down here to put options. And again, this will work. This is on any stock investing platform. Okay, and now that index is trading at 294. Okay, so if I want to protect myself from the market around there, then I would go down here to about 290. So 295, 290, you can pick where you want to protect yourself at, and you can buy these options to protect yourself at that point. Okay, now another way to use options, another way to use these options is those call options. Okay, now what a call option is, so we know a put option gives you the right to sell a stock or an index, gives you a right to sell that at a specific price, right? Now the call option gives you the right to buy it at a specific price. Okay, now, we're talking about protecting ourselves from the market falling or from a specific stock falling. So you're not necessarily wanting to buy the stock or buy it. But what you can do is you can sell those call options. Now, in the put options that we just talked about, you were buying those put options. So you were buying the right to sell it at a specific price. With a call option, then you can sell it, and that means that you can sell it for that price, or somebody else, you're giving somebody else the right to buy it, right, at that price. So if I had, we'll go back to Apple here. Well, we'll stay with the SPY. If I owned this index, the S&P 500, the SPY ETF, but I was kind of worried about where the price was going, I could go down here to 295, or wherever I wanted it. This 295. I could sell those call options to somebody. Somebody would pay me $13.70 for the right to buy it at 295. So basically, I'm collecting money on my investment now, and that's basically what we're saying is that decreases what I paid for the investment, right? If I'm a new investor here, I buy for 295 on the index, or I buy the index for 294 where it's trading at. I can sell those call options for $13.70, and really I only paid 281 or 282 for that index, right? So I'm selling some of my exposure in it. Okay. And then of course you've also got short selling, which is basically just borrowing the shares to sell into the market. I don't use that a whole lot because you still have to pay interest and stuff on that. So that's just really two strategies really to help get this protection in those options. If you don't want to necessarily sell stocks, but you still want that protection. We've looked at the economic data, we've looked at the earnings data, and you don't necessarily want to sell your stocks, but you still want to protect your investments. So now we're going to go to the questions here, and again, if I didn't answer your question or see your question earlier, ask it again in here. So we're going to go beginner to end. For the chart, comparing forward PE and 5 to 10 year average, financials health are 15 or lower. Is that good or bad for future investing since we've been in a long bull market for 5 to 10 years? Not quite sure. So basically we're looking at that chart on the, you'll see if I still have it. I don't have it up. But basically we're looking at which sectors have lower price to earnings, and the thing is you do need to compare it to that 5 to 10 year average, because utilities had I think they had like a 16 times price to earnings ratio, which is very low compared to that consumer discretionaries, obviously, which was like 21 times, right? But you got to understand that also utilities are typically a lower price to earnings ratio than some of those others. So you really have to compare it to its own average. And yeah, you look at almost all of them, besides maybe energy and a couple others, are over that 5 to 10 year average. So what does it say? It just says that stocks are expensive, and really you don't need a chart to know that. You don't need a chart to know that after 10 years of rising prices, stocks are expensive. So if you look back at some of the things we talked about, that earnings growth, the general economic scenario that's playing out, do you really want to be buying stocks that are expensive right now? And it just comes to our theory, our idea of either rebalancing, repositioning your portfolio to take some out of stocks and put it in that bonds or real estate, or just to buy that protection through options or through selling some short selling. What else? What else do we have? What are your thoughts on using options to balance? There you go. I love options. I don't do quite as much put buying, because you're actually, you're paying to buy that protection. What I usually do for most of mine is I'll sell those call options, right? Excuse me. So I will go into my portfolio, look at the individual stocks, and I'll say, okay, this one's had a really good run this year. I'm not quite sold on the company for that 1 year time period, but I still like that long term, outlook. So I'll sell call options, and it's called a covered call strategy, and it's really what I use options most for. It's just selling somebody the option to buy those shares away from me if they keep on exploding higher. Usually you can pick up a good 4 to 5% return on selling those options. If you sell them maybe at a little bit higher strike price, you still collect the dividends on all of your stocks, which is great. So it's a great way to still collect dividends and protect yourself from that downside if you see a little bit of downside coming. What else? Can use TZA for protection against a market crash. So actually, which one is TZA? I have to admit, I don't know that ticker symbol. Is that a market index or is that a TZA? I'm guessing it's probably kind of a leveraged ETF or something, isn't it? Let's see if we can bring that up here. Does anybody? Yahoo Finance is slow. TZA. Direxion Small Cap Bear 3X. I'm not a big fan of these leveraged ETFs, to tell you the truth. So what we're talking about here is this TZA ticker is actually an ETF. It's a small cap bear ETF. So basically, what these managers to this fund are doing, they are buying and selling derivatives, so futures or options or whatever, in a way that gives them 3 times exposure to small cap stocks, right? To the downside. That bear means to the downside, right? So they're betting that small cap stocks fall, and they're going to try to get 3 times that that return. The problem is there's a couple of problems here. One is just that buying and selling that derivatives position that they have to maintain, and they have to buy and sell on a daily basis. That means huge fees on these funds. So that's a very expensive expense ratio that you end up paying. The other problem here is, because of that, a lot of times because of that, over months, these tend to kind of lag the market because you have that huge expense, and they don't really follow that 3x idea. And they're these are definitely not funds that you want to be in for more than a few months. So I mean, I do know there are some people that use these for protection. So basically, if you think the market's going to be going down, small caps would be going down more typically than the larger market, than the broader market. So you would buy this, you would get like 3 times or so that fall in those in that index. And a lot of people do use that for short term. I kind of like the option strategy a little bit better just because it gives me more control. I can sell specific options on a specific stock or buy, I can buy call options on a specific stock. And it gives me a little bit more control about what I'm actually protecting against and what. Okay, so yeah, Greg had a good point here. The total option cost is actually the option price times 100 shares. Because when you buy an option or you sell an option, it's for 100 shares, right? So that's for 1 share, it's times 100 shares, which can actually make some of these larger stocks, Amazon, Apple, even some of the indexes a little bit expensive. If you're looking at, so $11 times 100, you're looking at $1,100 to buy 1 contract, which is worth 100 shares. So just something to understand when you are buying or selling these options for protection. Now, when you're selling them, then obviously you get that money. So it's not quite the case where it's money that you have to have. But when you're selling options, so if you're selling those calls to protect yourself on stocks that you own, then you actually get that money, in your account from that person that's buying the option. So if we're trading, Chip says, so if we're trading stocks for bonds, how do we find the best performing bonds? Honestly, I mean, unless you have $100,000 to put into specific bonds, then the cost of buying individual bonds a lot of times are going to eat into your returns. Okay, and what I mean here is the commissions, the brokerage fees and commissions and stuff that you're going to pay for buying a single bond, a single company's bond. And building that portfolio, because you don't buy just one bond or one company's bonds. You have to buy bonds in different sectors from different companies. So you need a portfolio of bonds. And unless that portfolio is going to be 100,000 or more, then a lot of times those fees tend to kind of override the benefits. So what I suggest is if you're unless you've got more than 100,000 to put in bonds specifically, then just go with the bond ETFs. And one of the bond ETFs that I bought for the portfolio that we'll talk about tomorrow in tomorrow's video is that BLV, which is a Vanguard bond index. They hold about 42% of the bond ETF of the fund in treasuries, so super safe there. But then the other 58% is in A and triple B bonds, so right around that investment grade. It's got something like a 3.75% dividend yield and great protection. It's excellent protection against stock market weakness and stuff. I actually share a chart for what it did during December's 18.5% drop in stock prices, and that actually made money. So yeah, I'd recommend just bond ETFs unless you have a very large amount to be putting in bonds. So Sean says, personally been researching companies during the '08 recession to find which businesses still had growth during that time period. It is a good idea, but you have to understand, how is the next recession going to be different from the last? I mean, I think the last, you're looking at different recessions. Okay, so the last one was very much a property-driven, interest rates-driven, that kind of thing. The one before that, the tech bubble, was very much valuation and tech, things like that. And then you got to kind of, you kind of got to get into the weeds here if you're going to look at it from that perspective. So the next recession, I think could be very much tied to corporate bonds because companies have been just going on a bond spree over the last 10 years with rates at historic lows. They've really been buying into these bonds. So so it might not necessarily be the same sectors that suffered last recession. It's a great idea, and obviously it's gonna give you ways to think about different sectors. But just keep in mind that there are going to be differences between the last recession and this one. So thoughts on U.S. steel stock, ticker X, recently 52-week low. See, steel's a hard one right now because you do have so much, government, policy changes and things coming into that. What I will say about steel, and I haven't looked at the stock specifically or into that industry specifically, but what I will say is even the Republicans in Congress. Okay, so you got the Democrats and Republicans in Congress are tasked with passing the USMCA, which is the NAFTA Part 2 or whatever you want to call it. That's in Congress right now, and they're saying, even the Republicans are saying, they will not pass this with these tariffs still in place. Okay, these steel tariffs, other tariffs that are that are in place, right? So if given the choice between getting this huge trade deal passed, which is something I think President Trump wants very much before that 2020 election. He wants to get that trade deal passed so he can have that to say. If it's a question between that and taking back these steel tariffs, taking these off, I think the steel tariffs are going to lose out. So if you're looking at stocks that have a play in that, especially U.S. Steel, then you might want to rethink that. How would taking off those steel tariffs affect that stock? So I would be hesitant on that. Greg wants to know pros and cons of selling puts to buy dividend growth stocks. So selling puts, so buying the stocks and then selling puts against it, or buying protection. Because if you sell, if you don't buy the stock, you're just selling the put, then you're not collecting that dividend. So it's actually probably not quite what you're thinking it's going to do. If you sell a put, then you have you make the commitment to buy it, at that price in a certain or a commitment to sell it in the future. But you don't collect. You don't actually have that stock, so you wouldn't be collecting the dividends on it. Now that's the reason why I use covered calls on my dividend stocks, because I've got the stock, I'm still collecting the dividend even while I collected the money from that call option. But if you're selling puts, then you don't. I mean, unless you buy the stock as well. But that protection, if you buy the stock, then you want to buy the put as well, because that gives you that downside protection. So I'm not sure, quite what you're trying to do. Selling a put to get into a position at a future lower price. Yeah, and that's another strategy that I use. I've used it every once in a while. Basically, what we're talking about is if you sell a put option, that gives someone else the right to sell it back to you at a certain price, right? And they're going to pay you for that option, right? They're going to pay you, a few bucks to be able to have that right. So basically, you can say, okay, well, I'd be willing to buy Apple, at this price at a future date, but you're not actually buying Apple, or you're not actually buying those dividend stocks. So you don't get any dividends in that meantime. Now, where this option strategy works is that you have a you have a certain price that you want to buy a stock at. Maybe it's not there yet, but you'd be willing to buy it for less in the future. So you collect that options premium. It is a good strategy. I don't necessarily use it a lot. I did use it for I think I used it for GE to pick up some more GE shares just a few months ago. Was when it was right around $8.50 a share. Then I sold some puts on it for like $9 a share. So I said I would be willing to buy it at $9 a share, but I want to collect that money and kind of wait and see where it goes. Sean says, have you used dividend yield theory, especially for dividend kings and aristocrats? What's your opinion on that strategy? I haven't really used it that much. Haven't really looked into it. I actually do talk about the dividend aristocrats in an upcoming video on. I've got a coming video series on dividend yield, the ex-dividend date, and the payout ratio. A great 3-part series in how to pick those dividend stocks, what to look for in dividend stocks, and some really interesting dividend strategies around that dividend date. Key strategies for analyzing companies that are heavily influenced by commodity prices. So ADM, energy stocks, materials. That's a lot of that. You got to go really deep into that specific industry, where you think prices are going. And a lot of times, like we talk about on the channel, it helps to have that professional knowledge in that specific industry, in that specific commodity, and the companies that are influenced by that. Because that's a whole, that's an entire profession within investing, to understand how an industry works, how it's affected by those commodity prices and things like that. So really, you can do that. You can go into, another example is airline stocks. 40% or so of their costs are in that, in those fuel costs. So you have to be intimately aware of where fuel costs are going. So basically, a lot of these stocks, that it is a great investing strategy if you can understand a specific commodity or a group of commodities, because it's kind of, they're going to track very closely, right? If energy prices go up, fuel costs go up, then, there's not a whole lot that the airlines can do to not go down, right? That one's going to be more of an inverse relationship. So it's, if you can get a handle on those commodities, then it's a great strategy, but you have to be able to understand where those commodities are going. So go to Bloomberg, go to Reuters, go to theft.com to read everything you can on those commodities, and try to get your own perspective of where those are going. I will say that one of the few bright sides, I think, maybe of the stock market, the indexes, I think might be in that energy sector. So if you're looking at energy prices, you've got the situation with Iran, the embargo and all that. That's kind of a key political point that Trump is using, and he's not going to come off of that. So you've got limited supply out of Iran. You've got the situation in Venezuela, which isn't getting any better either. So you've got kind of a floor on energy prices, I think, over probably the rest of the year. If the situation in Libya's always been very volatile on oil supply. So if anything happens there, you could see oil prices shoot up. So I think you've got a floor on prices right around $60 a barrel, and the possibility for prices to go much higher. So I would be looking at some of those energy stocks, specifically maybe even MLPs, which have kind of lagged the market this year. But it's a great yield play. I think the Alerian MLP is offering something like an 8% yield. So that is definitely a sector that I would be looking at as you're thinking about maybe protection from some of this other stuff. What else do we have? Can you show an example of selling covered calls with AT&T? 3,000 shares at bottom last year. Okay, so let's open up. And yeah, I can show you. Okay, so if you've got AT&T, and I'm going to go into Yahoo Finance here, and ticker symbol T is AT&T. So we'll go in there. So you've got AT&T, right? So if you own shares, you've got 3,000 shares at the bottom last year. I mean, it really doesn't matter where you bought it or what. Basically, you're looking at today's price, where you think it might go, if you're worried that it's going to go down, something like that. So basically, selling covered calls. Okay, so you've got AT&T selling for $30.70. You go over here to options, and this is going to work. Like I said, this is going to work on any trading platform that you use. Now, your first question is, how far out do you want the protection? Are you worried about AT&T specifically, where maybe a specific earnings date? Maybe you're worried about a specific date as far as regulatory dates. Whether you find out whether that integration, the acquisition integration is going to work well. So you really have to look at that. If you're just looking generically at some protection, then maybe you just do the January calls. Okay, these January call options are the most heavily traded, those January of each year. So basically, this is a call for AT&T January 17th. The call options always trade or always expire on the third Friday of the month. So you're going to have January 17th in 2020. Now, if you've got it at 30.70. If you're worried that it's going to go down, or maybe you want to give yourself a little bit of upside protection, right? But not much. We'll say 31. And you can do this at any price. Okay, you'll notice that the amount you collect on calls, if you're selling a call, then it goes up. The lower you go down. I mean, so if you give somebody the right to buy AT&T shares from you for $25, I mean, they're already $5 in the money. You're giving them the right to buy it at 25. It's already at 30, so they're going to have to pay you $5.90, almost $6, to buy that right from you. Conversely, if you're going to sell somebody for $35, somebody's saying, okay, I'll buy AT&T shares from you in January at $35. It's not worth very much to them because it's still $5 out of the money. It's only trading at $30. Why would they, unless they think it's going to just explode higher past 35, they're not going to want to pay you more than this 36 cents each share, right? And again, that's times 100 because each contract is 100 shares. So this would be, 36 cents times 100. So let's just go to this 30 though, right? Pretty much at the money. Other investors are willing to pay you $2.03 for the right to buy AT&T from you at $30 in January, right? So basically, you would be saying, okay, you've got yourself $2 in downside protection against a $30 share price, right? So that would be, about 6%, right? 2 divided by 30, it's about 6.7%, right? Protection. So those shares can go down to $28 by January, and you really haven't lost anything because you collected that $2 from somebody. Okay. Conversely, if AT&T shares do go up a lot, then your profit is limited at that $30 share price plus the $2 that you collected. Right now, the upside, you are collecting those dividends still, so you get the dividends until January. If the share price is above 30, then that person is going to buy those shares off you at $30 a share. If it's under 30, they're not going to do anything. Why would they buy those shares off you for $30 when they could get it in the market for maybe 29 or 28? So it's a great strategy for collecting a little bit of money, insuring yourself a little bit from the downside. But then still collecting the dividends, and you still, if the stock does go below that price, then you keep the shares. So that's a good, good way to do that. A few more questions here. What do we got? Could you make a video covering red flags for businesses you're investing in or for your own businesses? I actually do have a when to sell stocks video, beginner to end. I've got it's a video on 5 signals to sell stocks, and none of these have to do with a falling stock price, really. The 5 signals are things like, okay, is there management accountability? You get a lot of these stocks that will plunge on maybe a lawsuit or fraud or something, some kind of headline out of the company, and then that's not necessarily the time to sell, because that's already baked into the stock price. Okay, it's already plunged. You've already lost that money. What you want to do is you want to see if there's accountability. If management is doing what they need to do to get that company back on track. Things like that. So you've got stuff like that. You've got change in faith of leadership. You've got a change in some of these other metrics that we talk about, like the PE rate or the payout ratio. Things like that. So look for that video. It's when to sell stocks here on the YouTube channel. Outlook on renewable energy stocks. I actually don't cover renewable energy a whole lot. And what you need to do here, if you're trying to think of renewable energy stocks, then you need to look at those incentives that are coming out and the price of energy. Right, so obviously when energy prices go up, then the renewable energy stocks look better, because obviously those companies, those renewable sources are worth more. But it's also a matter of looking at the policies behind those renewable, those tax credits, the regulations, things like that. And the problem is we're seeing a lot of in these renewable energy stocks lately is that the administration is very friendly to that traditional fossil fuel industry, right? We're seeing a lot of these renewable energy tax credits and these incentives roll off. They're not being updated. We're seeing a lot of the regulations come off of the traditional fossil fuel sector. So it's just a very tough time for the renewable energy sector. But you'd have to look into those specifically. What else do we have? Cardano. Should I believe in all the hype surrounding marijuana stocks? Great question, Rebecca. So Rebecca wants to know if she should invest or believe in all the hype around marijuana stocks. It's a tough industry. That's one of the industries that you got a lot of the Bitcoin related stocks, things like that, are going to trade a lot more on the hype than they are on the actual intrinsic values of these companies, right? So it's much more of a trader's kind of sector. Okay, so yeah, if you want to get into marijuana stocks and you want to trade, trade on where the stocks are going to go over the next month or two, then that's one strategy. But as far as investing in them for the long term, for a year or 2 years or 3 years down the road, the problem is there is so much hype in there right now that the stocks are trading on that hype. The stocks are trading very expensively on all of the investors just piling into these names, and they're not necessarily great companies. They're not necessarily companies that are going to be around for 3 or 5 or 10 or 20 years. So I mean, it's one of the sectors that I kind of I avoid, just because there is all that hype priced into it. I want to pay. When I buy a stock, I want to pay for its intrinsic value. Okay, I don't want to pay for the hype, whether it's market hype, whether it's sector hype, stuff like that. So, I truly believe that marijuana will be legalized across the United States within the next, 5, 10, 20 years. It's just the trend that it's going to, and we won't get into the health benefits or risks to it. But it's a trend that is going to happen. The problem is, a lot of these companies, they're just not going to be around, and they're so expensive based on that hype. So, I wouldn't go with it. Is there a time to sell REITs? So Nicholas wants to know when I would sell REITs. And I mean, REITs are kind of a part of my broader long-term strategy. I think REITs, so REITs are real estate investment trusts. These are companies that own real estate, rent that out, commercial real estate, and then they pay back at least 90% of their profits as dividends to investors. So it's a great dividend yield sector, and a great way to get your real estate exposure without having to manage rental properties. With REITs, they're very interest rate sensitive. So again, like we talked about, a lot of these commodity sensitive stocks, then there's other stocks or other sectors that are very sensitive to interest rates, right? You've got utilities, you've got REITs, real estate investment trusts, even consumer staples to a certain point are very sensitive to interest rates, right? So you've got to have an idea of where you think interest rates are going and how that's going to affect the stocks. Now with REITs, with the Federal Reserve almost definitely on hold, they're not going to be raising rates for the rest of the year. Probably not going to be lowering rates either, but they're not going to be raising rates. So that is very good for real estate. You don't see a lot of the headwinds to real estate, to those leveraged loans that they use a lot of times. So I would be, in comparison to a lot of the stock market, the regular economic stuff that we've talked about, I would be putting money into REITs and bonds rather than the stock market. So I wouldn't be selling REITs by no means. What else? What else do we have? Yep. So what are other questions here? Stance on video game stocks, especially the high scare from Fortnite. So actually, I didn't hear about the scare from Fortnite. I don't know what that's about. This is a trend that's been developing for so long. These video game companies that put out physical video games versus the ones that you can have download. I really haven't followed them a whole lot. I know GameStop has been perpetually at risk for bankruptcy or perpetually in hard times because people just aren't buying those physical games anymore. They're just downloading them. They're using them on their computer and that kind of thing. So it's a tough industry to be in for those retail kind of shops. I haven't looked at a whole lot of the video game stocks as far as even the downloadable ones. I know there's a couple. I know Tencent is very good, is a big one for China, for the China play, and I think that's something that you could look in because you've also got, not only do you have the trend towards video games and stuff like that, and you'd probably want to look at more kind of a demographic trend as well, as to see if people are still having a high adoption rate on these stocks and really spending as much time on video games as they have been. But you've also got that China play, right? China growth as well, so you can combine the two and into maybe a good into a good investment thesis for that particular stock. So what else? Any other questions? I think actually, oh wow, we've been on for an hour and a half. This is it's kind of quite a bit longer than I thought it would. I thank everybody for showing up. This is you lose track of time because I love talking back and forth with the community and having these live chats. Like I said, check out that video tomorrow is our portfolio update for our 2019 stock market challenge. I'm going to share some of the other ideas why I'm selling, that earnings, dividend, and PE model that I use to see. And when you look into that, you're really going to see kind of where we're running into a dead end. So make sure you check that out tomorrow. That video is coming out. Again, I always appreciate any comments, any engagement on the videos that you can. If you see a video coming out, and even if you're not particularly interested in the topic, click through and leave me a comment. So tell me why you're not interested in that comment, so I can get an idea of what we want to see here on the community as far as videos and stuff. Again, I appreciate everybody spending your time with me this Sunday, and I will see everybody next Sunday at the same time, noon Central, so 1 p.m. Eastern Time, 10 a.m. Pacific Time. If I didn't get to your question, please, it's going to take about an hour to process the video, put it on YouTube, ask it in the comments. I respond to every single comment, and I appreciate every one of you. So thank you, and I'll see you next week.